I'm going to bring on board our next guest who's joining us all the way from Boston. So who better than Punita Kumar Sinha to really give us a flavor of what are things on the ground in the US and how is she reading into the India market sitting out there. Punita, hi, morning. Thanks so much for taking the time out and joining in. Firstly, tell me, how's the mood in the US with regards to the coronavirus? I guess self-isolation at a time when Trump has even, banned travel to the UK now must be utmost priority.
No, the mood here, I was in India about 10 days ago, and I can tell you that the mood in the US is far more grim than in India. And, here, for instance, if you go to the grocery store, it's really a struggle to even find the basics like paracetamol. There's no hand sanitizers available, toilet paper, onions, potatoes. Everything is like sold out. People are hoarding this stuff because they're expecting of, quarantine coming and people having to sort of stay indoors. Restaurants are closed, pubs are closed. Of course, India is doing some of the same today. But the mood here is really, really grim. And, in a place like Boston, I think the number of cases are almost the same as, say, what you find in India. So obviously, New York City, Boston, San Francisco, the big metros have quite a few cases. And that is really concerning the government. And I was hearing what Nikunj was saying that the Fed has acted, but the Indian government hasn't really acted. And part of this is because I think the number of cases in India are still lower than what you see in the US, and the severity of the impact on the business activity in the US is far more right now. Everybody has to work from home. A lot of stores are shut, and therefore the whole retail industry, people's jobs are at risk. So there's a lot of pain that is forthcoming here, at least over the next couple of months on the economic side.
Yeah, and that really is the unfortunate part, Punita, and I guess that is what is reflected in the screens as well over here. But tell me, now with the Fed sort of, being proactive as it's being looked at and sort of ahead of the curve as opposed to the rest of the central banks across the world, do you really think it can sort of arrest the situation with the economy as well as the markets right now? Or do you think the problem, like you're describing to me, the scene in Boston and New York, is far more grim than what the market is reflecting right now, and don't even expect a bottom anywhere close?
Let's separate out the economics and the markets. So on the Fed cut, that is really going to just help the demand side, because the demand and consumption demand is going to be quite weak, with people not being able to step out of the house or, even business. A lot of people's salaries are going to be impacted as well. Companies are bracing for, a painful future. And so a lot of companies are raising cash and are kind of tapping into their credit lines. So this rate cut will help that side of the equation. So the companies will be able to tap into their credit lines at lower costs. And so the financial side will be positively impacted, as well as the fact that the companies then have reserves to coast, basically out of this bad period. In terms of the impact on the financial markets, I think the bond markets obviously will react perhaps a little bit more positively than the equity markets have, at least on the futures. That's because I don't know to what extent this is really going to help the economy in terms of demand. Probably not very much, but it'll definitely help stabilize a lot of the pain that the companies might face down the road. And so I think the financial markets are right now reacting to all the negative news coming out of the coronavirus, and perhaps less so on what the Fed is doing.
So, Punita, if markets are not reacting to US Fed, if markets are not getting excited at a time when interest rates by the biggest central banker have come down to zero. So I just wonder that what could be the backstop, because if conventional ways of financial repair stroke rescue are not working, I understand it's a medical situation, but then what will please the market? What will act as a circuit breaker? What will be the green light?
Well, I think, the next 2 weeks are very critical on the coronavirus. So if you look at what's happened in other countries, week 3, week 4, week 5, that's when actually week 4, 5, and 6 is when the graph can either stabilize or the cases keep rising. So I think if the next week or two, the number of new cases kind of stabilizes with all the social distancing mechanisms that have been put in place, then all the, basically the impact of what the Fed has done will start reacting in the markets more positively. So I think everybody's kind of taking a wait and watch attitude. One of the other things that I'm noticing in some of the endowments, that they are also having to raise cash to be able to, preserve some capital to be able to pay the workers, because the markets have been up a lot. So the endowments cash situation has also been on the low side compared to the economic downturn that might be coming. So a lot of selling is happening because large institutions are just and corporates are raising cash as well.
Right. So Punita, we've got a lot of experts who've come on the channel and have said it's time to buy fear. If you buy fear, you're rewarded. That's the nature of the financial market. But do you think one should not get trapped by them? Do you think equity as an asset class, I mean, the good part about equity is that it will always stabilize first. But in the short term, do you think one should actually avoid getting seduced by this entire price fall, which is looking, because of the price fall and because of the percentage decline?
Well, it's interesting. If you look at what's happened in China, the equity markets there, despite the coronavirus and the impact on the economy, the equity markets, in fact, have actually been one of the better performing markets, right? And that's partly because of the way I think China's handled the crisis. The number of new cases are not increasing at a fast rate anymore. So if we are able to find that same kind of stability coming on the coronavirus in other markets, in other economies, that's going to be kind of the trigger for when I think one should be looking to get back in aggressively. Of course, there is going to be a recession. I don't think there's any doubt that we are heading into a global economic slowdown. But of course, the market valuations are also beginning to reflect. There's a lot of panic built in. Stocks are down over 12 months. Most markets are down 30%, between 20 to 30%. Valuations and many companies are beginning to look attractive again. So I think one should be ready with a list of stocks to buy. But perhaps over the next 2 weeks, things will become a little bit more clearer as to the impact of this virus on the economies. If the virus isn't arrested the way China was able to arrest it, if the rest of the world isn't able to arrest it, then the economic impact will be far worse than what is being discounted in the markets.
Punita, I'll request you to stay on with us. By the way, the latest update is that we're at 94.06 on the Nifty, the Sensex down 1,960 points nearly. And, it goes without saying that every sector and every stock pretty much has been battered across the board. Rahul Chadha, the co-chief investment officer at Mirae Asset Global Investments as well, joining in. And Rahul, it's getting more frightening now to look at the screen, because despite what has been done by the US Fed, it seems like sentiment really changing on the coronavirus front will be the only thing that could perhaps appease the markets.
Yeah, no, clearly there are a couple of things which were weighing at the back of mind from a market perspective. First and foremost was this parabolic jump in coronavirus cases we've seen in Europe and US. And in the US, we've just seen free testing begin this way. So I think the numbers are going to spike. Look, we've seen these cases before. We've seen in China, we've seen in Korea, you get a big spike. And what you need is an effective quarantine. And after that, things kind of come under control. So next 1 or 2 weeks would be kind of a fairly scary headlines, but it's a move in the right direction. It's a move in the right direction from what we've seen, parts of Spain being closed, Italy being closed, Germany closing borders. In the US, most of these sporting events are being closed. So those are steps in the right direction. News flow is going to be ugly for the next kind of a couple of weeks at least. What we need is, we've seen the Germans come and say they're ready with the bazooka to help the small businesses. We've seen Fed give enough liquidity, but it's not a question of liquidity here. It's more a question of confidence. So that's where we need to see U.S. administration expand this program to help the small businesses. $40-50 billion doesn't move the needle here. You need close to $400-500 billion program. So if you have governments supporting the economy by kind of a nearly $500 billion or $400-500 billion of programs, and in next 2 weeks, markets seeing that the growth in new cases in Europe has plateaued, the growth in new cases in the US has plateaued, and I think that's where markets will take comfort and bottom, basically.
You know, given the acute spread of the virus at a time like this, a lot of economists are saying that a global recession is already here.
Economic activity has come to a halt. And I'll keep going back to China example because that was something which happened first. If you see in China, in the southern part of China, somewhere near Hong Kong, Guangdong province, you've seen normalization happen to the extent of 70%. Schools are open over there. In interiors of China, you're seeing slow normalization happening. So things are coming back on track. Again, 1 or 2 quarters here don't matter. When we look at stocks, we look at least 10 years. 10 years are 40 quarters. Even if you lose 2 quarters of earnings, it's 5%, and stocks are down 30-40%. So there is deep value here. I think the fear is of a financial system collapse, etc. And that's where, as markets realize that governments are doing whatever it takes to stabilize the financial systems, as markets realize that, look, like the trajectory the virus has taken in Asia, it's taking the same trajectory in Europe and in the US, and kind of a subsides in a couple of weeks, markets will get the comfort.
Not even good. Punita, let me take that forward to the point on value, because seeing what we did on Friday, and we have actually had quite a few experts come on and talk about how they started nibbling it at lower levels. But I mean, if we take a look at the screen this morning, continuing to look incredibly risk averse. Do you see momentum completely skewed in the sense that even if there is value, will there be reluctance to buy in even at lower levels?
I think it's going to be mixed. Definitely the long-term investors who have cash already are probably going to start nibbling in at these levels. But if you look at what happened in 2008, the Indian markets crashed about 60%. So we are down halfway on that mark right now at about 30%. And this crisis could be just as bad. That's one way of looking at it. But again, one can't time the bottom perfectly. And so I think my sense is that those who have cash and have taken a long-term view will probably start nibbling in. And as we're already seeing some people do that. But then the others who are cash-starved and need the cash will have to sell regardless. As I mentioned, some endowments and some pension funds and some corporations in the US have to sell because they need to raise cash for the earnings shortfall that they might be facing. And so there could be some selling coming from that as well.
Okay, right, Punita, really appreciate your time. Thank you for joining us. Rahul, there are 2 options for investors right now. One, you deploy more cash, which could be good or bad depending on your risk appetite. The other option is that you churn and you prioritize what you want to buy and what you want to hold. Suppose this price carnage within your Indian allocation, have you started changing the allocation this way or that way?
Okay. Honestly, nothing much, Nikunj, at this time. The valuations, the price levels are very attractive. One wants to keep some gunpowder dry. And like the way I said, in next 2-3 weeks, you will get your time opportunity to buy into India. There are parts of markets, something like a consumer staples, where valuations are still expensive, and from a longer term perspective also the risk reward may not be that favorable should the risk appetite normalizes. So one may use part of that to add to financials, one may use part of that to add to real estate. Real estate got smashed in last 2 months. But look, unless or until you're believing that these companies are going bankrupt and you have a 3 years time frame, you're going to make money here. So I think a lot also is a function of time frame. See, 6-9 months probably, it may take a while for things to recover. We are talking of a base case scenario where after Europe and US, the virus kind of subsides because temperatures go up. But let's take a bear case scenario where the virus moves to LATAM where the temperatures are getting cooler. Then the markets may take a longer to recover. So if you have a 3-year time frame, I think over next 2-3 weeks, definitely investing would make sense and you'll make money from a 3-year time frame. If you've got a shorter time frame, 1-year time frame, probably one can just wait a bit more on to emerge, to get some clarity on the virus and then start nibbling into it. And what thing I'll also add here is, I think these are unprecedented times, and these unprecedented times call for unprecedented solutions. We saw that in Asian financial crisis, that we had the Hong Kong Central Bank or the Monetary Authority, HKMA, come and buy and support the market. So clearly that is something which can be thought of. Again, the regulator, I believe, is already looking into whether there is excessive short selling in the market. All those things can help because, see, fundamentals are not secondary now. If you look at the price moves, it's more the sentiment which is dominating. And I think somewhere all these factors help mitigate these excessive swings of sentiment, basically.
Okay. Rahul, let's talk about good old consumption stocks. In India, in India, consumer stocks were expensive. Now that's where the entire crunch will happen. Are you a bit surprised, unlike global companies who are openly admitting the problems what they have? I have not heard from any Indian corporate coming out on a public forum or informing the stock exchanges that what would be the real impact of earnings.
Okay, I think the events happened way too quickly in last 3 or 4 weeks for some of these businesses to come and impact. As we go in April season, and that's where we'll get the earnings call, that's where we see the first quarter results. We will see consumer discretionary get more impacted than others. We've seen some of the airline companies kind of inform stock exchanges on the huge disruption to the business. But I think in April earnings call, you will see at least the consumer discretionary get more impacted. But look, as we were discussing earlier, Nikunj, if one gets comfort that this virus is subsiding, some of these consumer discretionary companies offer great entry points. We go back to our basics, and basics is at least you value companies on 10 years of earnings. That is close to 40 quarters. Even if you take a 6-month, half-year impact, that's barely 5%, and stocks are down 30-40%. So unless or until we believe that these companies are going out of business, the risk reward is favorable from a longer-term perspective.
God, I'm just looking at the screen right now. We're down 6% now in the Nifty. It's 600-point shave off that you're seeing. And I don't even want to get into individual names because the cuts are as big as 12% now for IndusInd Bank. ICICI Bank is now down 9%. HDFC is now down 8.5%. So this is clearly capital protection, which is playing out right now for equity markets here in India. Titan, Axis Bank, the blue chips are the ones which are caving in today and leading the fall really on the index. But Rahul, you're in Hong Kong, and the only thing which is sort of going in favor of Hong Kong is they know how to deal with a virus like this. They've dealt with SARS earlier. But tell me, what is the situation really there? Are things pretty much under control? Because Hong Kong was the first to really isolate and quarantine the entire country.
Yeah, absolutely. See, that is what is required. You need to be paranoid about the spread of this virus. And that's what happened because Hong Kong had gone through this painful experience of SARS in the past. The moment the virus broke out in China, the entire city went into a paranoid state. And that's where it's kind of helped the city limit the infections to below 200. So I think it's still kind of a cautious state for us. Schools are closed here. It's work from home from most of the companies here. But look, what that's helped is control the spread of virus, and that's where I get the confidence that look, now that Europe is getting paranoid about the spread of the virus, we saw that in the US over the weekend they've announced free testing kits. You will see a spike in cases over the next 2 weeks, and I take an example of China. I take an example of Korea, where you saw a spike in cases, but now you look at the daily cases from China and Korea, and those daily cases have subsided to less than 100. So once market realizes that, look, Europe, the spread is under control, US, the spread is under control, and you're not seeing large-scale bankruptcies because the governments or the central banks are providing the necessary kind of firepower or necessary support for these businesses to stay alive. And then people will start focusing on valuation. See, right now, if you look at the behavior, it's really that the whole system is imploding and nobody's interested in valuations. But once those extreme existence fears settle down, normalize, people will look at valuations. And that's where, again, the risk reward would look phenomenal, basically.
Rahul, great to have you on the show. Thank you so much for taking the time out and joining in with those quick thoughts.